All right. Good morning, everybody. We're one step closer to the end of the week. It certainly does not feel like a Friday. We've got some we got some jobs data coming in today, and we have more jobs data coming in tomorrow. The the bigger thing today is um, the War Powers Act and the president's right as a president to do what he's been doing for the last 6 days. So if we look at the White House risk, there's two things going on. It's a concurrent House War Powers vote on the Iran conflict and a White House press briefing on the military strikes. Intelligence briefing and policy meetings suggest active crisis management. So that's what we're looking at. The score is 72 out of 100. So this is high risk based on the current schedule. It looks like it's going to happen later in the day. Or is that policy meeting right here, 5:30? So, keep your eye on the news, see if, because that seems late to me. It's very likely it's going to happen somewhere else, like within the regular trading session. I was poking around looking for some other site to give us that. So that'll be the one that you really want to keep your eye on once we get past the job numbers this morning. Now, later today, we do have just, the regular chit chat where different Fed officials are, talking out the side of their neck. That's normal. I wouldn't see this one with Bowman being impactful at all, other than the regular risk that we get when one of those Fed members is talking. The gotchas, or where they inadvertently say something that gets taken out of context, something like that. We do have an auction today too, but it's not a 1 o'clock auction, so there shouldn't be a problem with that. Tomorrow's really the bigger jobs number. Today's, I mean, I would never suggest that we ignore data, or that, you don't anticipate some response when it comes to job numbers, but really today's numbers are nothing compared to tomorrow's. So that's really the bigger deal that you want to keep track of. We're still seeing uh, markets reprice where the potential for a rate cut is at. The stronger target at this point is September. So we're looking at um, the unwind for June and July getting pushed out to September, October, and by December, it looks like they're putting in two. Like we would have two cuts by the time we got to December. But really, just keep your eye on September's curve. That's the easier one to focus with. CTA positioning, they're still just lightening their risk. You can see they're not aggressively selling, or that line would be pointed more aggressively to the downside like it was back here, right? A steeper slope, steeper rate of change. We do have Christine Lagarde speaking from the European Central Bank. Not sure how much impact we're going to get out of that, but as usual, we just want to be prepared in case she happens to say something that's taken out of context or, they throw a curveball at her. The put wall rolled back up to its previous position, so we didn't get much out of it. Yesterday it was a small move down, and now it's just a small move back up. We're still just sitting in the same range that we've been sitting in forever. Got the zero gamma and the volatility trigger kind of pinched between those two. Overnight volume 147,000, so we are still seeing a decrease. We were running in the 200s Monday and Tuesday. So, we got below the 200 threshold yesterday. Now it's even lighter, but the average is around 50,000 and we're still hitting it at 150. So it's certainly still elevated. We look at that to try to gauge if there was a lack of participation, right? And that's usually what we're looking at this for. But the other side of that coin is uh, a lot of participation, right? Like what we've been seeing all week. So when I started using this years ago, I was just trying to identify if there was something coming at me this morning that maybe was making them sit out and not participate, or if there was a market that was closed somewhere around the world that I had missed, right? Because keeping up with the US holidays and all of that is enough when you're new, but when you don't even consider other nations and their holidays when you're new, then it's even worse, right? So nowadays I just use that free website tradinghours.com, and you can check to see if a nation opened last night or if they had a banking holiday or something like that. But still, the overnight participation is a nice insight into what was going on. And if we have elevated partition or if they sat out and it was really light, then it kind of tells us to go look around and try to find out why. All things considered, we got a really good start to the day, right? With this tight range, all we got to do is get out the box and let the good times roll. We did get some lower lows this week, and we're still working on these lower highs. That Linreg line that I just snapped shows the market's direction here. It's possible we're going to get down into that 66.50. The purple line down there is the 200-day moving average. It's very likely we're going to get down into that level. It's these previous lows down here, right? 6,600, 66.50, maybe a little bit of an overshoot. But we're still just messing around in this box, right? That's that's what has to change. And it's hard to see a path out of this box before OPEX simply because of the amount of structure that's been developed on both sides of this range. It's like those gutter blocks that you can put in when you go bowling with the kids, right? So that the ball won't fall in the gutter. Guardrails. The market's got guardrails on right now, and we could break them if something really bad happened. We could, break the lower rail and fall. Or if something really good happened, like peace in the Middle East, we could break the upside and run. But really, without something extraordinary, it's hard to see a path outside of the box or outside of the range until OPEX removes those rails. Now, the thing is, we don't necessarily have to make it through the end of the OPEX day for that to happen because they begin to move their positions before they expire. They roll them, right? So while there's still time left on the clock, they begin to roll those positions, and that's going to start to create the window in the week leading up to OPEX. OPEX is always the third Friday of the month, so sometime around the 17th or the 18th, they're really going to start doing that. And by late on the 19th and into the 20th, they're going to be hammering it pretty hard. Now, for the futures, the contracts roll on either the 13th or the 16th. Not like the contract closes. The contract will stay open until the 20th, but most brokers will auto roll, and for the ones that don't, they'll have these little pop-ups that are encouraging people to roll. So most people will get off of the March contract on the 20th or the 23rd. Excuse me, on the 13th or the 16th. I was looking one more day ahead. So by the time we get into Tuesday of OPEX week, most of us, won't be using the March contracts anymore. And that's just another example of the guardrails being removed, because they're going to be getting out of anything connected to those contracts as well, all of the options that are on them. You can always go back and study the open interest changes for contract events in the futures. That might be a bit out of the wheelhouse for you futures traders that never really paid attention to anything more than the price action, but there is open interest that you can track as well. Yeah, you put those gutters in the way, you can bowl a 300. So yesterday we were looking at the same situation we have today. We got near the ADR yesterday without hitting it, and then we had picked up and moved away from that ADR. It's the same thing today. Maybe close is close enough. Just to kind of highlight what I'm talking about here. We got close to it yesterday, but we didn't hit it. We got close to it today, but we didn't hit it. It's kind of the same thing. So if we can break our own Globex high, we'll aim for 69.32 cog line or this ADR half up here. Get above that, and we'll aim for the full ADR. I was thinking about this miss from yesterday and again today, and all of this is based on a math formula, right? We're measuring the size of the daily bars, and we're looking back over a 21-day period and then running an average of that. All it would take is a couple of these long wick bars to give us, say, 3 points on either side that gives us just a little bit too much. And that can account for that yesterday and today. So I'm thinking the average just got a little overstretched. It's all statistics and it's a nerd thing. So basically, what it comes down to, if we wanted to just clean it up and give it to it simply, is that the ADR lines that we're seeing might be off by a few points simply because of the extreme of the wick moves over the last few days. Because with anything, as with anything, it's just a math formula, right? course, it'll normalize within the next 21 days. So as long as we don't get more continued wild, extreme, large wick reversal bars like that, then there shouldn't be any issue. And there never has been an issue before, or I just didn't catch it before. It's something I'm going to be digging into to find a different way to normalize these ADRs rather than just using a generic 21-day average range. I've used it for years. I really like it. Maybe I'm just a little overreaching, right? There might not be anything to it. Maybe I'm just seeing shadows. All right, today's floor pivot is higher than yesterday's. That's bullish. Price opened above it. That's also bullish. We've already come down and hit it, so we don't have a missed daily pivot. And so far this morning, we're holding above it. Now we're still underneath that weekly pivot, but we did give it a good run. We challenged it yesterday. We couldn't quite get there. We tagged it last night and wasn't able to stay above it, but we're giving it a good challenge. That is the line that we need to get through on the week if we're going to try to get anything else done, right? Otherwise, that's going to cap us for the week. That's our ceiling. And if we can't get above that, it's very likely we're going to back off again. It's one thing about the markets, right? If they can't get through a level, they've got a process. Usually the first process is to step back and take a run at it. And then if that doesn't work, they just wash it all out. We can see they stepped back to take a run at it. That was a significant step back. We're seeing another step back this morning. It seems to be a much smaller pullback right into the floor pivot level. The last time this happened back here, we cut right through that floor pivot and didn't interact with it until we were underneath it. Back here, we interacted with it and was able to hold it. Only a six pack? So this morning, if we can cut underneath that floor pivot, then we'll focus on yesterday's levels. Which we'll lay out once we get done with the 65-minute. All right, to the upside, 69.24 is R1, and then 69.70 is R2. 6,800 S1, it lines up with yesterday's floor pivot, which right now is something that we're going to be carrying forward anyways. If that floor pivot lines up with yesterday's point of control, I'll have to see where that lines up. Otherwise, we don't have much with this S level, and we got S2 down here. The S and R levels at this point holding a little better than the ADR levels. You see it. We came into contact with R1 yesterday. That's finally what shut down the run. Or maybe we just ran out of time. But I think we finally reached the target. All right, distribution on the week is still not all that great, but you can see the work that was really put in across this high. We got the point of control at 68.85. Any move to the upside between now and the end of the week is going to have to deal with that 85 level. Then we got the roundy 6,900, and then, we'll challenge some of this trash from back here. This is a little bit of a lopsided distribution, but all things considered, it's still just a really wide value area. So That 6803 that we were just talking about is the value area low, and then it really gets thin. All right, what I just did there is marked yesterday from its highest point to its lowest point. If you're struggling to mark yesterday's levels with the quadrant lines, just go out to the daily and do that. The fib won't get drawn to where price is, so that can be a little disconcerting, but it does put the drawing on today's price where you need it to be, right? But there's two ways that we can measure it, and it's not about, well, which one should I use? You can use both, or you could just choose to use the full daily. What I'm measuring here is the RTH of yesterday. Once the bell rang at 9:30 into 4 o'clock, we can measure just that price action. That's just the RTH alone. And you can see that since we measured a narrower area, we have narrower 111 and 1236. They're just smaller lines, right? They're closer to price. They're about 5 points off. So you could just do one or you could just do the other. It doesn't matter. But if you're dealing with a smaller time frame, then probably want lines that are closer to you, right? So if we do get the top side breakout, we're going to aim for the 111 and the 1236. Otherwise, we've got yesterday's mid 6832 cog line, cut that level, break through yesterday's RTH low, and then we'll focus on yesterday's real low. Along the way, we got the big round number 6800. It's a big options level, so it's worth keeping on the radar. And of course, we got 6850 to deal with. We get underneath 6850, it opens the door for 6750. Level by level by level, all the way down. Simple, it's easy. It's a nice, clean, tight little range this morning. So, we're set up nice for a move. All we got to do is get it started. Ten-day, 30-minute volume profile in TPO. The value area has really tightened up quite a bit because we're working through the final days of that tight, nasty range that we had. Then we had a bit of an expansion and we started to really get things done after that. It reminded me of a draw and a raid, right? The draw is where we go sideways, it draws everybody in, and then we raid liquidity on one side and we cut through the whole thing and go the other direction. It's kind of what it reminded me of. That's not helpful unless you're just doing a look back though, right? So we're back up, we're pressing against the point of control for the 10-day. There's just so much structure here, so much trash, that it's like we were talking about earlier. If we're going to continue to look for an upside move or an expansion lower than what we've already set in here, we're going to have to get through these guardrails that are in place. We're going to need something really significant. We just haven't got it. All right, I was thinking maybe that VPOC was going to be down here, and it's not, right? Instead, it's up here, and it's not a VPOC because we've already hit it. So we're done with that level. That's off the table. Ah, my level got changed. Try that. The March 2nd POC was hit yesterday. We're done with it. Before we take it off, though, it's always worth examining what price did at that level. It kind of helps reinforce why do we even bother carrying these lines forward. It's the purple line there, which is a little hard to see when I zoom in. So we're just going to change that real quick, make it easier to see. Price came up, interacted with it multiple times. It struggled repeatedly to get through that level. And then, of course, we finally did make it through, but it was quite a bit of a fight to get that done, right? Now, it's not always going to work out that way, but it was just one more detail. Remember, Monday had all of that volume early in the morning. When we came in, it was like, what, 250, some really high overnight volume. Then that afternoon, they came roaring back in and put in all that work in that structure up there. So when we got back to it, it wasn't much of a surprise that we were seeing a lot of activity again, right? Trader's remorse, unfinished business, whatever you want to call it. So we're done with that level. We still got one more overhead from Thursday. It's not as exciting as Monday's, but still a level of interest. Want to keep our eye on it, 69.20. If we get that breakout above our own Globex high today, we still have Monday's high to deal with. And then we've got that VPOC level from last week. Still sitting inside the box for the week. Of course, all of that can change with one headline, but it's what we've got for now. And we are IX10, which isn't helpful because we're kind of stuck inside of a big bar. But this is the big bar that we're stuck inside of, right? The first day of March, first trading day of March. Now, some analysts won't count this because we got outside the box. Even though we didn't stay out, we didn't even close out, but we got out of it. And then we came back in again. So some analysts will say, well, it's not an IX10 because of that expansion. I don't do it that way. I think if you make it too extreme like that, if your qualifications are just too much, then you won't ever get one, and you'll miss out on the analysis that they provide. So this is an IX10. It is a relatively wide range, so it's not overly helpful, but that is our new reality. It is the world that we're living in, and we got to get out of this if we're going to get anything else done. So GTFO. We are around 0.5% below the 10-week. That is not too much. It is not too far or too fast. It doesn't owe us anything. And that makes sense because we haven't gone anywhere, right? We are inside day for multiple days, which means we haven't done anything. So this isn't overly negative. It's not heavily bearish. It doesn't bring big bias to it. There's just nothing here. And the same thing with the daily because, well, we haven't done anything. Right? If we haven't done anything, we haven't gone anywhere, then we're just still here. Right? So nothing to see here, folks. All right, looking at what's down this morning, China and more China, and then more China, and a little bit of China in there too. Bonds, really, it's just all China. Consumer discretionary, just a little wee bit, but that's it. Right? It's really all we got. Looking at what's up this morning, nat gas. So excited. Not. Nat gas is up 8.5% in a 5-day period. Be a little careful with that. Excuse me, wrong. Was off a level. Nat gas up 3.5%. Not so bad. Never mind. 3.5 isn't bad. Nat gas being up almost 9%. That was making me think we were going to get some kind of reversal, but I was on the wrong line. Mag 7 up volume is up almost 9%, right? Well, 8.5. That's a lot. Over a 5-day period, it's up 8.5. So might see the up volume take a little bit of a pause. All these other things that we're seeing, they're not up or down 0.5% or more, so not really offering us a lot on that front. If we were trying to quantify how much market breadth we had, there's just nothing here, right? So where's our push going to come from? It's not going to be market breadth at this point. Maybe we get into the open and we get some 0-day flows or some headlines. At 8:30, we could get, the jobs data could give us a little bit of juice, get us moving. Otherwise, we got nothing. The base case for today is that we go sideways into tomorrow's data unless the jobs numbers are off radically or we get some sort of macro shock headline that we can't see coming at this point. Right? We got all of this jobs data. That auction really isn't a big deal. It's just the 4-week. I know we shouldn't dismiss it like that, but really the history of the 4-week causing drama is really low, which is why they have it as a low impact. And Bowman, whatever, that's just a waste of space. So if we make it through the jobs data without some, wild radical event, then the only thing left would be whatever comes out of the White House today. And I'm not even going to try to anticipate that. So keep your eye on anything that talks about an impromptu speech, the president talking, meeting with anybody, doing an extra press briefing, anything like that that could cause markets extra exposure. Otherwise, it's very likely that we stay in the range today. So if we do break either to the upside or the downside, I'm going to be looking for the reversal and bring it back in. Because if I'm wrong, if you game it out, right, it's not about winning all the time. It's just about making sure that your losses are small and your wins are bigger. Game it out, play the reversal and bring it back in. And if you're wrong, that means it's actually breaking out and it's making the run. Fine. Get stopped out, take a small loss, flip the trade over, take it the other direction. 69.50 would be the ballpark first target to the upside because we're running 50s. And if we get through 50 and we keep going, then 7,000 is the next level because we're running 50s. So I'm going to be playing the reversal to bring it back in because I don't expect to see it break out today unless it's something coming in that we can't see right now. If we go up and break out with a different pattern or a different setup and I want to change that, I will put it in the chat. Right? But for now, that'll be the ballpark. Last thing I want to talk about really quick is the possibility of a liquidity gap. Today's data shouldn't cause this, right? It shouldn't. Not today's data. Tomorrow's, yeah, it's more likely tomorrow. But at 8:30, we could get a really big bar, right? Like just one really big bar. We're going to use this bar, even though that's not the one. We'll just use this. So at 8:30, we could get this big expansion bar. If it's bullish and it closes in the upper 25% and there's not a lot of wick on the bottom, look for price to come back to where it started. Because we're going to treat it as a gap Even though it's not a gap in price, it is still a gap, right? It's a liquidity gap. But it needs to be a big bar. And when you try to gauge, well, how big is a big bar? It should be larger than the bars that are around it, the bars that came before it, right? So if the average bar, look at what we've got this morning. These bars are not that big, right? If one bar is as large as that, well, that would be a large bar, right? Because it's like the size of all of these bars combined. So you're looking for a very large outsized bar. But we don't want some big janky wicks on both sides kind of bar, right? Because if there's wicks on both sides, it's going to close near where it opened, and then there is no gap to close. It already closed it. I will post it in the chat if we get one and measure it out, highlight the levels. The reason I bring it up is because that big bar could be bullish and it could shoot us out through the top of the range. It could. I don't know where we're going to go when we get the jobs data. Neither do you. Just be mindful that most of the time when we get one of those bars, bearish or bullish, we don't continue to move in the direction of the bar. So if it's a really big red bar and we go down, it's greater than 50% chance that we unwind that at some point and we come back up to where we started at the bare minimum before we do anything else. Same thing if we go up, we're very likely to unwind that and come back in, right? So just a heads up, watch that big bar. I don't think we're going to get one today anyways. I think it's going to be tomorrow, but be ready for that just in case. So what I got, guys, be careful, be safe.